Hey guys, what's up? Just trying to record a video. Why don't we ever just sit down and talk? What do you mean? We talk all the time. Yeah, true, but it's always you just spitting out investing knowledge. I'm just trying to keep you informed. That's true. But how have you been? You know what? You're right. I've been good. My investment's been taking a hit recently, but it's all good. How about you? I've just been chilling, but yeah, I agree. The market's been really crazy. I don't even know if I should be investing. You need to go task. You're supposed to be making a video. You're right. I'll get to it. Well, then get to it. So, what exactly is this video about? I want to do about something that will overall really help the viewers and also entertain them. That's pretty much usually the overall goal. You know what I mean? Well then, we gotta think of something. You know what? We've been chatting so much, I haven't even had a chance to figure that out. You need to get into the viewer's mind. That's what you need to do. So then, what exactly are your thoughts on the investing world right now? How should I know? I don't even know if I should be investing right now. That's great. Let's talk about that then. You're gonna make a video for people that don't know if they should be investing right now? Yeah, we can go over different times to invest and different mindsets and all that type of stuff. Now that I think about it, that's a really good idea. Yeah, the whole point of the videos are to help you and go over stuff that you're interested in and that you have questions about. Yeah, that's good. That's good. Can you do something for me first though? Yeah, definitely. All you need to do is just go ahead and like this video. Yeah, I can do that. Yeah, just go ahead and click the thumbs up button right there. Yeah, just turn it blue. Yep. Done. Thanks. That really means a lot. During a market crash. The stock market is always crazy, but during a market crash, things can be even more uncertain. During the coronavirus, nearly everyone has had their lives disrupted in some way. Most Americans are worried about the effect it will have on the US economy, with millions of workers watching their savings account plummet. When the market is in freefall, it can be tempting to pull all your cash out of your portfolio in an attempt to salvage whatever money you have left. However, during a recession, it may be a smarter move to do the exact opposite. Actually invest more in the market. Of course, not everyone can invest. If you lost your source of income and are simply just trying to keep your head above water, it might be a better idea to focus on paying the bills and establishing an emergency fund. But if you have cash to spare, investing it may not be a bad idea. But why? Why what? Why would investing during a recession be a smart move? The stock market is on sale. When the market falls, so do stock prices. That means that by investing during the market downturn, you can get more for your money because stock prices are at rock bottom. You've probably heard of the concept of buying low and selling high, and during a recession, it's a perfect time to do so. It may take a while before the stocks market fully recovers, but it should bounce back eventually. The economy will always experience ups and downs, some worse than others. But if history has showed us anything, it's that the market will always recover. By investing when prices are low, you'll be setting your savings up for significant gains when the stock market does eventually recover. And hopefully, by the time you're ready to withdraw your cash from your portfolio, your investings will be worth much more than they are now. In other words, buy low now so you'll sell high later. You can avoid decisions fueled by emotion. One of the most challenging aspects of investing is sitting on the sidelines, watching your investings take a nosedive and knowing that there's nothing you can do about it. It's human nature to want to do something to help your investments, but unfortunately, sometimes the best thing you can do is nothing. If you let your emotions fuel decisions, there is a chance that you could end up doing more harm than good. You might choose to withdraw your savings from your portfolio or just quit investing altogether because it feels less risky than continue on investing. But reality says those could be costly mistakes. Instead, convince yourself to keep investing constantly, no matter what the market does. Delete your retirement account app from your phone or log out of the website to avoid feeling disheartened about your account balance. And keep reminding yourself that things might not look pretty right now, but they'll get better. Adjusting is better than quitting. As you get older and closer to retirement, you should be adjusting your assets to ensure your investments align with your risk tolerance. Okay, but what would you do if the market's already crashed, but you haven't been conservative enough with your investments already? The best option may simply just be to stay the course. Adjusting your portfolio to ultra-conservative investments now would potentially lead you to never seeing your savings bounce back from its losses. Once the market does start to recover, though, it's better to start investing more conservatively than it is to stop investing altogether. That way, your money will be as protected as possible against future market downturns, but still be building wealth. Keep in mind, though, that even older investors should usually invest at least some money into the stock market. Even if you're in your 70s, you'll still want your investments to continue growing wealth at least a couple more decades throughout retirement. While it may be ideal to have most of your money in more conservative investments, it's wise to avoid giving up stocks if you want to continue seeing long-term growth. If you're feeling worried about your investments, that's perfectly normal. But remember that historically, the market has always bounced back after even worse recessions. It will recover this time too. But by continuing to invest now, you'll reap the rewards later. Okay, I get it. Just keep investing during a recession. Yeah? What about during a high market? During a high market, whenever there's been an extended bull run, one question that comes to mind: should I invest in the market now, or should I wait for a pullback? The question comes about because of fear and loss aversion. Fear that the market will drop right after they invest, and the observation that people want to avoid losing more money than their value gains. However, historically, the correct answer has been to invest and not try to time the market. This is also proven in the market timing strategy, that people are pretty bad at predicting the direction of the market and figuring out the upwards trend to the market. It's more likely than not better to just stay invested in the market. The correlation to this is that when you have additional money to invest, it makes more sense to invest the money and not worry about whether the market is high or the market is low. So, last question. Yeah. What does a great investor do when they're worried about the market? Well, fortunes are made and lost in a blink of an eye. While most investors are bullish overall, meaning they expect the market to go up, even the most seasoned investors get skittish in certain environments. Here, I'll give you 4 steps great investors take when they're worried about the market. Liquidate risky positions. When some investors sense danger ahead, they follow along with the general census and sell investments. Smart investors start by selling risky possessions, like those with high beta and history of volatility, and those with new business models. Others sell the possessions in even the most stable companies as protection against loss. However, experienced investors do not follow the nervous investors who rush to sell everything and sit in the sidelines. If you sell everything, you can miss out on big gains if the market bounces back from its lows. Instead of selling everything, top investors just sell the risky investments in their portfolios while holding on to stable investments in firmly established companies, such as blue chip companies. Hoard cash. Some top investors don't sell when they feel downturn coming, but they'll stop investing any extra cash they would normally invest. Investors holding large amount of dividend stocks, for example, may turn off reinvestments and hold on to the cash as a hedge against portfolio losses. Hoarding cash allows you to weather the storm relatively unscathed if markets turn sour. Even if your stocks lose a lot of value, investors with cash stashed away can wait for the perfect moment to begin investing again. The gains experienced when riding the market upward out of a recent crash can help offset losses in the stocks you held onto through the downturn. Shop fixed income investments. Investors may move their funds into fixed income investments when the market looks unstable. Fixed income investments come in many flavors, including bonds. Bond prices tend to move inversely to the stock market, so when the stock market price falls, bond prices rise. In the event of a large market downturn, bond prices may fall along with stocks, although their yields should increase in turn. The bond market is made up of different types of debt securities. This includes corporate bonds, government bonds, and municipal bonds. Corporate bonds are a debt instrument issued by large corporations. Government bonds come in different varieties. Municipal bonds are issued by local governments, and they often come with tax benefits. Buy, buy, buy! Famous investor Warren Buffett once shared this gem of wisdom in his annual letter to shareholders. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. In other words, when the market is flying high and people are bragging about profits, a fall in the market prices is likely to happen soon. On the other hand, when investors are fearful and worried about poor conditions, a market upswing could be on the horizon. One way to buy stocks during a down market is through strategies known as dollar cost averaging. This is when investors continuously contribute the same amount of money every month to their investments. When share prices are high, they may only be able to buy a few shares, but when prices are low, they'll be able to buy more. In the long run, this strategy lowers the average price per share that they own and can be a smart move if
and most likely when the market rebounds. These buying strategies are not without risk. While investing in a down market often pays off big, there is a chance that the market hasn't hit its bottom yet. But when the market finally does begin to rebound, you'll be enjoying larger gains than the people who didn't buy during the market slip.
Okay, I think I get it. Always keep investing and holding for as long as smart. Yep, that's exactly what I've been trying to tell you. Investors just always have to stay positive and keep their knowledge up. Exactly. So, what now?
Now, go ahead and like this video if you already haven't. The YouTube algorithm really recognizes your likes and I really appreciate it. Also, go ahead and comment what you've been investing in during this recession. I can't wait to read the comments and respond. My last request is for you to subscribe. It really makes me happy when you guys subscribe, and it also allows me to keep you updated on the investing world. Finally, if you were looking for a brokerage, no need to look any further. In the description section below, I have 2 links. One link to Robinhood where you can get 1 free stock just for signing up to the link. And another link to Webull where you can get another free stock just for signing up to the link, and then 1 more free stock when you deposit $100 into that account. I hope this video helped and I hope you found it entertaining. Thanks for watching. See you next time.